Hello guys, welcome to your first lesson on Fact 1 and Fact 3. We're going to get started now. Just to give you a outline on this week's class, we won't cover a question tonight, so we'll probably have this lesson about around 1 hour, 60 minutes. The reason why I don't still cover a question in this week, because we're dealing with conceptual framework and presentation of financial statements. I mean, we can find questions for it, but it's basically going to be tested within within the other topics. So I'm just going to give you a high-level overview of the conceptual framework and the key aspects of it, and then I'm going to give you a high-level overview of presentation of financial statements, and then that we will cover. And then as we do, for example, next week or this week, we'll do inventory, and then income statement, income taxes. Then I'll show you how that all link together. So the whole purpose that I do presentation and conceptual framework in week 1 is because it is pervasive. It covers every topic throughout financial reporting, including group accounting. So just be aware of that. So for this lesson, it's just going to be a high-level overview, and then there won't be any question today. So let's talk about the conceptual framework. So with the conceptual framework, the whole purpose of the conceptual framework, it's basically the Accounting Standards Board, the IASB, the International Accounting Standards Board. They use the conceptual framework as a basis to set new accounting standards or to evaluate current accounting standards. That's the one reason of the conceptual framework. The second reason for the conceptual framework is for you and I, when we are in the real world and we are preparing financial statements, there may be instances where you come across a transaction that is not within the accounting standards, and then you need to use the conceptual framework to come up with an accounting policy and all of those type of things. Okay, so that is the purpose, is to provide you with some guidance as to the purpose of financial statements. So when you are stuck, you use the conceptual framework as a guidance. As I said, when the ISB set standards, they use the conceptual framework as a basis for setting the accounting standard. That said, there may be instances where the conceptual framework contradicts the accounting standard. You should know that the conceptual framework is not an accounting standard. So there may be instances where the conceptual framework contradicts the accounting standard. And in that situation, you always choose the accounting standard. The accounting standard always prevails. How do we know that? It's because the conceptual framework says so. Okay, so when you read the conceptual framework, they will tell you that the conceptual framework is not an accounting standard. And in a situation where the conceptual framework contradicts an accounting standard, then you apply the accounting standard. The accounting standard always prevails. Now, the conceptual framework is new, as in a new conceptual framework is out. I'm not going to go through all the details, but just a high-level understanding of the conceptual framework. So the conceptual framework deals with the objective of financial reporting. Remember, we are dealing with financial reporting. That is how we report financial information, and that comes in the form of financial statements. Okay, so just be aware of that. So the objective of financial reporting is to provide users with financial information that is useful for decision making. So keep that in mind. It is to provide financial information that is useful for decision making. Now, who are our users? There are two types of users. You have your primary users and you have your secondary users. Financial reporting is mainly concerned about your primary users, and your secondary users is not a main priority. your information that you provide will be useful to them, but you are always focused on providing financial information that is useful to your primary users. Who are your primary users? Your primary users are your current and potential investors, as well as your current and potential lenders and creditors. So that's very important. So when you think about a transaction, and when you want to present financial information and you want to disclose financial information, then you always have to ask yourself, is this financial information, is this information useful for decision making? Okay. So the question is, how do we achieve the objective? The standard sets out qualitative characteristics that will help you achieve the objective. So you have two types of qualitative characteristics. You have fundamental characteristics as well as enhancing characteristics. So the fundamental characteristics are as follows. So the fundamental characteristics are as follows. It's two things. It is faithful representation as well as relevant information. And then you have your enhancing qualitative characteristics, which are there's four. It is oh, it slipped my mind. It'll come back to me now. What's the four? It's complete. It is I just slipped my mind. I'll come back to it now when I recall it. So keep in mind that information have to meet the fundamental qualitative characteristics. It must meet the fundamental qualitative characteristics. Your fundamental qualitative characteristics are twofold: relevant and faithful. Now, something is relevant if it will impact a user's decision. So, something becomes relevant if it will have an impact on the user's decision making, right? And under relevance comes materiality as well. Then you have faithful representation. Some financial information is faithfully represented when it has three aspects. Number one, it is complete. Number two, it is unbiased. And number three, it is accurate. Okay. Now remember, you have to understand that accuracy does not mean that it has to be 100% correct. An estimate can be accurate. So just be aware of that. It might just be at the point in time when you made the estimate, you used the best possible information available that any normal and ordinary person would use. So just keep that in mind. So your financial, so to meet the fundamental characteristics, it must be both relevant and faithfully represented. Now remember, relevance, if it will have an impact on users' on a user's decision making, and it includes materiality. And then number two, it must be faithfully represented. Something can be relevant, but it's not faithfully represented, then the information is useful. Something can be, then the information is useless. Something can be faithfully represented, but it is not relevant, then the financial information is also useless. And we need to provide useful information. So it needs to meet those two qualities. Okay. Enhancing characteristics, just as the word suggests, it just improves what you are representing. So, for example, one of it is comparability, that you want to be able to compare last year with this year. Now, so that makes it that enhances your information. So just keep that in mind. Another enhancing characteristic makes it understandable. So if you can make the information more understandable, that enhances the fundamental characteristics. So why is enhancing not required? Like we said, one of the enhancing characteristics is understandable. So you can't say Because this information is too complex, that we're not going to include it because it's not going to be understandable. Because remember, understandable is only an enhancing characteristic. If that information, even if it is complex, is relevant and can be faithfully represented, then you should disclose it in your financial statements, and you can't argue that you're not going to disclose it because it's not understandable. So just keep that in mind. That is why you have to look at fundamental. Once you meet the fundamental qualitative characteristics, you then look how can you enhance it through the four enhancing characteristics. Like I said, comparability is one, understandability is another one. I can't remember the other two now. Yeah,
Complete.
is completeness one, and then there's another one. Okay, so just keep that in mind. Okay. Um, Then to move on into so far in the conceptual framework, we covered the objective of financial statements, and we covered how do you achieve the objective through the qualitative characteristics. Then there are more other things, for example, like the reporting entity. Who is the reporting entity? There's more other stuff. What I want to come to is now the accounting equation. In the conceptual framework, they define the accounting equation. They define what is an asset. They define what is a liability. They define what is equity. Then under equity, they will define what makes something income, what makes something an expense. Remember, when you think of the accounting equation, everything in accounting, everything in accounting falls somewhere within that accounting equation. That's derived from the accounting equation. So the accounting equation goes as follows: assets equals equity plus liabilities. The way you attempt a transaction, whenever a transaction is complex and you don't know um, the journal entries for the particular transaction, then use the accounting equation. For a transaction that you know, like easily, for example, let's say depreciation. Depreciation is an easy journal entry. We always say debit depreciation, credit accumulated depreciation. Without you even knowing, you are actually applying the accounting equation. Now, when a scenario is complex, you're going to actively or consciously, you're going to have to consciously apply the accounting equation. So how do you go about applying the accounting equation? You have to do it as follows. You start off with assets. You ask yourself, do I have an asset? So remember, an asset could either increase, an asset could either decrease. The only way you're going to know if you have an asset, as in increasing or decreasing, if you know what is the definition of an asset. And you answer that. If the answer is yes, the next question is, do I have another asset? Until the answer is no, or until your accounting equation balances. So the first thing is, do I have an asset? Yes. Another question, do I have another asset? And if the answer is no, then you go to the other side of the equation. What is on the other side of the equation? It is equity and liabilities. You start by asking, do you have a liability? You start off with liabilities. Do you have a liability? And you ask yourself, if the answer is yes, you ask yourself, do I have another liability, or is the accounting equation balanced? If the answer is no, and the accounting equation is not yet balanced, then it has to be equity. Remember, why does it have to be equity? Because the definition of equity is as follows. Equity is the residual, meaning the leftover of assets after, is the residual interest in assets after liabilities have been deducted. And that is why the way you apply the accounting equation is by starting with assets, then going to liabilities, and any leftover, if the accounting equation is not balanced, have to be equity. So do I have an asset? Yes or no? If the answer is yes, You ask yourself again, do I have another asset? Um, and until the answer is no, or until the accounting equation is balanced. If the answer is no and the accounting equation is not yet balanced, then you have to go to the other side of the equation and you start off with liabilities. You ask yourself, do I have a liability? And you will say, and if the answer is yes, you ask yourself again, do I have another liability? Until the answer is no, or the accounting equation is balanced. If the answer is no for liabilities, and the accounting equation is not yet balanced, then it have to be equity. Now, when you come to equity, what is equity? Equity is defined as the residual interest, residual mean left over, the residual interest in assets after liabilities have been deducted. So when you are left with an amount and you have no more assets, no more liabilities, it have to be equity. But now here under equity, you have to be very, very, very careful. Although equity is one balance, equity have three components. Or let's first start, equity have two components. It could either be a business transaction. It could either be a business transaction or an owner transaction. This is critical. If you're not going to pay attention to this, you're going to lose quite a bit of marks and you're going to be penalized. So remember, every university, including psyche, is very harsh if you get your equity incorrect. So you need to distinguish between an owner transaction and a business transaction. An owner transaction is a transaction with an owner in the capacity as an owner. So that's very important. So it's a transaction the company has with the owner in the capacity as the owner. So just be aware of that. For example, let's say like Eduhans is a company. I am the owner of Eduhans. If I, let's say for argument's sake, I register for a course through Eduhans, that is not an owner transaction because I'm not transacting with the company in my capacity as owner. I'm transacting with the company in the capacity as a customer, as a student. So in that case, that transaction will not be an owner transaction. Okay, it will be a business transaction, assuming I am transacting as a pure student. An owner transaction from a company perspective is one of two things. It is either me giving money as capital into the company, and that would be capital contribution, or I'm taking money from the company in the form of dividends because only an owner can get dividends. So when a company pays dividends, a company pays dividends to an owner. It is only because you're an owner of a company can you get dividends, and hence that would be considered an owner transaction. Similarly, it is only in the capacity of an owner can you contribute to a company as equity, and as a result, that is an owner transaction. So it's very, very important to distinguish between an owner transaction and a business transaction. An owner transaction is where a company transacts with the owner in their capacity as an owner. So, for example, for a company, the owners of a company are the shareholders. Only shareholders can get a dividend, and only shareholders can contribute by, because remember, to contribute to a company is by buying shares of the company. So the moment you buy shares of the company, you are transacting as an owner. The moment you get a dividend, you're only getting a dividend because you have a share in the company, and that becomes an owner transaction. So that's critical. So what's important about that? Every owner transaction goes directly to equity. Any owner transaction goes directly through equity. What does that mean? An equity transaction usually goes through the income statement, either through profit or loss or through OCI, and then it goes to the statement of changes in equity. However, a owner transaction does not go through the income statement. It goes directly to the statement of changes in equity. I can't stress this more. If you're not going to get that right, you're going to get the answer wrong. Plus, you're going to get a subtraction of 5 to 10 marks. Now, 5 to 10 marks is a lot of marks. So just be aware of that. Okay. So an owner transaction goes directly through equity. Okay. A business transaction can be one of two things. So business transaction is income and expenses. Another term, gains or losses. Okay, same thing. Gains or losses, income and expenses, same thing. Um, so income and expenses, a business transaction either goes through goes through the income statement, but either through the profit or loss section or the OCI section. How do you know what goes through OCI? So the general rule is everything goes to profit or loss unless a standard specifies that something goes through OCI. So every business transaction goes through profit or loss unless a standard specifies that it must go through OCI. So for example, when we come to PPE IAS 16, you have two measurement models, the cost model and the revaluation model. IAS 16 PPE or property, plant and equipment specifically says that when you use the revaluation model, any revaluation gain or loss goes through OCI. So there they're specifically telling you that gain or that loss goes through OCI. So therefore you can't take it to P&L. Another example in financial instruments, in IFRS 9 financial instruments, if you have an investment in an equity instrument, you can choose how you want to measure it, either through fair value, through profit or loss, or fair value through OCI. If you choose fair value through OCI, that means the fair value gain and the fair value loss will go through OCI. So just keep that in mind. So under equity, you have two types of transactions: owner transaction, business transaction. An owner transaction example is dividends, share capital. Those transactions go directly through equity. Um, then you have business transactions. Business transactions, income and expenses, gains or losses. These can either go through profit or loss or OCI. The general rule is everything goes to profit or loss unless the standard specifically tells you that that particular transaction needs to go through OCI. That is why, if you should be aware of it, because in third year, UNISA was big on it as well, that whenever you do a journal entry, you have to specify SFP, E for equity, or P&L or OCI. So SFP means asset or liability, meaning asset or liability. So what we left with, equity. But when it came to equity, we either had an E, which means it goes directly through equity, or we had P&L, which means it goes through the profit or loss section of the income statement, or we had OCI, which means it goes through the OCI section of the income statement. Very, very important, because these are fundamental principles of accounting. Okay, so please be aware of that. So that is the conceptual framework to a large extent. What is the objective? How do we achieve the objective? And then the definition of assets, liabilities, and equity, and the definition of income and expenses. The definition of income goes as follows. Income is an increase in assets or a decrease in liabilities other than a transaction with the owner. So you see there, other than, with a transaction with the owner. An expense is a decrease in an asset or an increase in a liability other than a transaction with the owner. So just be, I'm just paraphrasing it. Okay, there's a little bit more like formal terms, but that's basically the definition of income and expenses. What is an asset? An asset is a resource controlled due to a past event from which future economic benefits are expected to be obtained. Okay, so it has three components: a resource controlled due to a past event, and future you expect future economic benefits. The definition of a liability: it is a present obligation due to a past event or as a result of a past event, and you expect an outflow of future economic benefits. So in the asset, you expect an inflow of future economic benefits. For liability, you expect an outflow of future economic benefits. That's the definition. Now remember, from an asset and liability point of view, something can meet the definition, but the only time it can be recognized on your financial statements if it meets the recognition criteria. The recognition criteria is twofold. Number one, the amount must be measured reliably, and number two, the outflow or the inflow must be probable. So just be aware of that. Slightly changed due to the new conceptual framework, but largely that is still the rules or the principle. So just be aware of that. Um, and like I mentioned in one of the other Zoom classes that I ran earlier, when they say, "Dear student, please discuss a particular transaction in terms of the conceptual framework," what do you need to do? You need to discuss in terms of whether this item is an asset, liability, or equity. Okay, so just be aware of that. So that's all from a conceptual framework point of view. Please read it. Make sure, I just need to, I hope you have your green, or your IFRS books, and please make sure to read through them. Okay, as a CA, as a aspiring chartered accountant, you are expected to read through your accounting standards. Remember, you're going to use it when you write your tests, when you write your final exam, when you write ITC, and when you write APC. Okay, so please make sure, and you're going to use it when you're in the real world. Okay, so please make sure that you do make time to read through it. So that is a high-level overview of the conceptual framework. Before I move on to presentation of financial statements, do you have any questions? No questions? Ashita? I always call out your name first because you're right on top.
No questions.
Nothing. Fakir?
I have a question.
Yes?
When you mentioned the conceptual framework, and you said you'll have to mention whether whatever they're talking about is an asset, liability. I remember you once mentioned that it's either they'll ask conceptual framework or subsequent measurement. Can you please just repeat what you said about subsequent measurement? What would be expected from you?
Subsequent measurement. um, Maybe there's some confusion. So when you, well, what they will are this like taking from the conceptual framework type question, there's two ways I can ask this. Number one, I'll actually try to find the question um, that we got asked when I was in third year. One of the lecturers asked in our final exam. Final exam, there was a question asked regarding this whole thing. Why we kind of were able to answer it because he stressed it out throughout the year. He probably knew what he was going to do, so he stressed it out throughout the year. I'll give the exact example, and I'll try to share it on the platform as well. And in and then that question, the GDA or the CTA lecturer used that in as one of our tutorials. When I looked at the solution, I got the thing completely wrong, and I'll explain to you now. So the scenario was as follows. Well, it was a huge scenario, but to simplify it, It was basically a scenario where a company, I think, had dogs, but as guard dogs. Okay, and the question was, how do you, how this company recognize these guard dogs? So, question number one, in terms of the conceptual framework, please discuss how company A will account for the guard dogs. So when they said conceptual framework, they're asking you, is the guard dogs an asset, a liability, equity, or nothing? Okay, so remember, if it's not asset, not liability, not equity, it's nothing. Okay, so we had to discuss. Um, and obviously, it can't be a liability. It was because it was guard dogs. You know, it's not a pet. Okay, so it was an asset. Okay, so we concluded it was an asset. It's a resource control. What is the resource? It is a dog. The dog is the resource. Do we control the dog? Yeah, we kind of control the dog to some extent. I mean, we purchased it. We have the papers of the dog and so forth. Remember, do you actually control the dog? Is that's like a separate issue. But in terms of the actual resource, you kind of control it because you bought it and all of those type of stuff. Okay. So it is a resource controlled. Due to a past event, the past event was we purchased the dogs, from which you expect future economic benefits. Do you expect future economic benefits? Yeah, they're guarding the property, so it's going to limit any type of break-ins and all of those type of things. Okay, so it meets the definition. Can we recognize it? Well, it needs to meet the recognition criteria. At that point in time, the recognition criteria was twofold. Can the amount be measured reliably? So yes, we paid for the dogs 100,000 rand, whatever it was, and so the amount is reliably measured reliably because there's an invoice. Is the future economic benefits probable? Well, in that scenario, given the information they gave, I can't remember the details, but it was probable. So we concluded, number one, question one was discuss how you account for these guard dogs in terms of the conceptual framework. So what do they want to know? Whether it was an asset, liability, equity. Okay. And remember, when you come to equity, you need to be more specific. Is it a transaction with the owner, meaning a dividend or share capital, or is it a business transaction as an income expense, and whether it's P&L or profit or loss? But like we said, it was guard dogs. I mean, it was an asset. So the way we think about it, because we paid for cash, the journal entry was like this. You always, if there's a bank transaction, always start with bank. So if you paid cash, bank is an asset. Bank is decreasing because money is leaving. So bank is an asset. Bank is decreasing. That means assets is decreasing. Assets decrease on the credit side. So we're in a credit bank. Okay. For every credit, there must be a debit. Now we know we are missing a debit. Remember, you always start with the easy part, and you must know the discussion is all about the difficult part. So that you're not going to discuss 10 marks about bank because we know bank is easy, credit bank. So for every credit, there must be a debit. Now I know there's a debit. This debit can either be an asset. If it's an asset, there must be an increase in assets. Or it could be a liability. If it's a liability, it must be a decrease in liabilities because liabilities decrease on the debit side. If it's equity, it must also be a decrease in equity. Equity decreases if it's a transaction with the owner, it has to be dividends. If it's a business transaction, it has to be an expense. So that's how you can kind of think about it. But basically, we concluded it is an asset. So we said debit asset. There was an increase in assets. So that was question one. The very next question, on question one, was 20 marks, if I remember correctly. The very next question, question two, also 20 marks. Discuss the discuss how you'd account for the guard dogs in terms of an accounting standard. So the question one was discuss in terms of the conceptual framework. The second question was discuss in terms of an accounting standard. Now, when we say an accounting standard, it means we said number one, it is an asset. Now, in terms of the accounting standard, which asset? So the way you go through it, I sat in the exam, I'm like, okay, the assets that we covered this year was as follows: PPE, inventory, investment property, intangible assets, biological assets. Biological assets are not part of our syllabus, but UCT covered it. So for our purpose, it was biological assets. And then you have leased assets and you have financial assets in terms of financial instruments. So now I'm sitting there, we have 7. You just eliminate. You know it is not financial instruments, so that's out. You know it's not a leased asset because we didn't lease it, so that is out. I know it's not inventory because we are not selling the guard dogs in the order. Sorry. So like I said, it is not financial instruments, it's not a financial asset because it doesn't meet the definition of financial asset. I eliminate that, so I'm left with 6. It is not leased assets because we didn't lease it, we bought it. So I eliminate that, I'm left with 5. It is not intangible assets because a dog I can touch. So therefore I eliminate that. So I'm left with 4. It is not investment property because investment property is either land or buildings. It is a fixed structure. Firstly, a dog is not land, it's not a building, nor is a dog a fixed structure. So I eliminate that, I'm left with 3. What did I say? It is not inventory because because we don't sell these guard dogs in the ordinary course of business. So therefore, I eliminate inventory. I'm left with 2. So that is what I was left with, 2. And I didn't study biological assets. And then I'm like, oh, okay, it's biological assets. So I quickly read the standard. That is because we have the standard with us. So I quickly read the standard. And unfortunately, because I never studied biological assets, or I did, but I just briefly, and when I read biological assets, I read the definition of biological assets completely wrong, but I concluded it was biological assets. I cannot remember what is biological assets. But when I saw the solution, when I came to GDA, it was concluded that it was PPE. So let's understand why. If I was more careful in reading the definition of biological assets, it was actually very easy to pick up that guard dogs does not meet the definition of biological assets. So I was only left with one standard, which is PPE. And as a typical thing, PPE is generally the leftover standard. But we could also argue why PPE is the actual standard, even though you eliminate everything else. So generally, you must eliminate all the other ones. And if nothing is there, you just say it's PPE. But you could also argue why it is PPE. So remember, PPE, it is a long-term asset, not more than 12 months. It is an asset. We concluded that in the first place. It is used in the production of income or for rental purposes, or it's owner-occupied, owner-used. So you could argue that this is an owner-occupied thing. The owner is using the guard dogs to actually secure his property. And that's how you concluded it was PPE. So that is basically what I was talking about, Mahlatsi, is that the first one is to discuss a transaction in terms of a conceptual framework, that is asset, liability, or equity. And then in the other case is to discuss it in terms of an accounting standard. So once you concluded it was an asset, liability, or equity, so if you concluded it was an asset, you have to then explain or identify what type of an asset. And that is where the accounting standard comes into play. So in many cases, they're not going to ask you to discuss the conceptual framework. But when they say discuss in terms of an accounting standard, they're inherently expecting you to quickly tell them whether it is an asset, a liability, or equity. So for example, when you say it is PPE, before it can be PPE, it has to be an asset. So you will tell them it is an asset. You don't have to go through the whole definition of an asset. You will just say it is an asset. It is long-term, meaning non-current. It is used in the production of income or for rental purposes, or it's owner-occupied, and it is tangible, and hence it meets the PPE definition, and therefore you will account for it in terms of IAS 16 PPE. So that is what I'm talking about, not about subsequent measurement. Subsequent measurement is the accounting treatment of the initial recognition. I hope that answers your question.
Yes, it does. Thank you.
Okay. So please be aware of that. If I find that a guard dog question, I'll share it with you, but just as something nice to have, like as bedtime reading, not really as part of the syllabus. Okay. Now let's move on to presentation of financial statements. Remember, remember that the whole purpose of accounting, of financial reporting, is financial statements. But to act, and that is to present something on the financial statement and or to disclose in the financial statements. That is the whole purpose. But in order to present the correct things and to disclose the correct things, you have to know how to calculate them and all of those type of stuff. And that is why calculation takes so much of the marks and the question papers. But remember, ultimately, it's all about presentation and disclosure. When you join a finance team, your main job when you're as a financial accountant or financial manager, you have a lots of jobs. Okay, you have lots of responsibility. One of the responsibilities is the preparation of the financial statements. And when you prepare financial statements, your the main objective of that is the disclosure and to deal with the auditors. And when it comes to the auditors is all about disclosure and presentation. So that you must keep in mind that although we focus a lot of our time on calculation, the ultimate objective is to present financial information that is useful for decision making. Okay. So like key aspects of financial statements, you need to understand what is a complete set of financial statements. So a complete set of financial statements is basically, sorry, quickly. A complete set of financial statements is a statement of financial position, the statement of profit or loss and other comprehensive income, the statement of change in equity, the statement of cash flows, and the notes to the financial statements. Then it also includes comparative financial information. That is why when a question does not tell you to ignore comparatives, you always include comparatives, because that is part of financial statements. Okay, comparative financial information. There's there's 7 things. Okay, can't remember the other one, but basically, that is a complete set of financial statements. So just be aware of that. So if they say, how would this transaction be disclosed in the financial statements? They're talking about all of those stuff. Income statement, balance sheet, cash flow statement, equity statement, notes of the financial statements, and comparative. There's a 7th one. I can't remember what's the 7th one. And that is why they'll generally specify which statement, because then you're only limited to that particular statement. So please be aware of that. Okay. The presentation of financial statements also deal with what is a current asset, a current liability, what is a non-current asset, a non-current liability. Okay, so be aware of that. And then it also tells you how what needs to be disclosed in the statement of financial position, what needs to be disclosed in the equity statement, what needs to be disclosed in the cash flow statement, what needs to be disclosed in the income statement. When it comes to the statement of financial position, the general approach is that you will have assets, equity, and liabilities, assets needs to be disclosed between or presented between non-current and current. Liabilities need to be presented between non-current and current. The only time you will not use non-current and current is when another basis makes more sensible, for example, like the liquidity basis. And that is generally in a financial services company. So what you can do for yourself is Google Signia. Take Signia, it's simple financial statements. Google Signia and pull their financial statements. Okay. And then Google ShopRite and pull their financial statements. You will see on the balance sheet, ShopRite will disclose between non-current assets, non-current liabilities, current liabilities. But if you look at Signia, Signia just have assets and liabilities. They don't split between non-current and current because it doesn't make sense for a financial services company. They will go from um, highly liquid to less liquid, basically. Okay, so that is a different basis of presenting your financial statements. Then you will have equity. Under equity in the financial position, you will have split between what belongs to the parent and what belongs to the non-controlling interest if you're dealing with a group situation. The statement of financial position, the ICE 1 also explains to you of typical examples of what needs to be separately presented on the statement of financial position. And basically, they tell you that any item that is significant needs to be separately presented. Anything that will be more useful for decision making will be separately presented. And they give you examples. They will tell you PPE is generally significant, so you'll have it separately. Inventory is generally significant, so you'll have it as a separate line item. Investments and so forth. Okay, so they'll tell you and they'll give you typical examples of what are generally significant line items, and therefore you show it separately. So that is the statement of financial position. In the income statement, here's a few important things you must be aware of. The income statement is known as the statement of profit or loss and other comprehensive income. That means the income statement has two parts, the profit and loss section and the other comprehensive income section. The income statement, your income statement can be presented in two ways. Now, this is a policy choice. The company can decide, and therefore you need to see in a question, what is the company's policy? It's not always going to be, so then you can do what you want to, but when they give you the company's policy, you need to follow that. So you can either have a one-statement approach or a two-statement approach. A one-statement approach is where you have the profit or loss and other comprehensive income on one page, one statement. Or you can follow a two-statement approach where the first statement is the profit and loss only, and the second statement is other comprehensive income. But what's important to note, if you follow the two-statement approach, the first page or the first statement is profit or loss. The second statement is other comprehensive income, but you will start off with profit or loss and then have other comprehensive income and then show total comprehensive income. So just be aware of that. Income statement can be presented in two ways, the single statement approach or the two-statement approach. Single statement, profit or loss, other comprehensive income in one statement, generally one page. The two-statement approach is the first statement of the two statements is the profit and loss section. And then the second statement of the two statements is other comprehensive income. But you start that second statement with profit for the year, and then you show other comprehensive income, which will give you total comprehensive income. So that's very important to note. Then there's further aspects to consider. Other comprehensive income can be presented in two ways. Okay, you either have it net of tax or you have it gross of tax. So remember, net of tax means when you have a revaluation gain, the revaluation gain is net of tax. And then when you have mark-to-market reserve relating to financial instruments, it will be net of tax. That if the company policy is to have it net of tax. If the company policy is to have it gross of tax, then it means you will have one line item called revaluation gain, a second line item called mark to market reserve, and then one line item says taxation, which accounts for the tax of both line items. Very important to note that. Once again, if they are testing it, they'll make mention of it in the policies of the company. But if they don't make mention of it, you just follow what the question actually have, or you follow whatever is easiest for you. But you just need to be aware of that. The third aspect that you need to be aware of when it comes to the other comprehensive income section is that other comprehensive income section, besides for net of tax or gross of tax, there's another split when it comes to the other comprehensive income, and that is there's two splits. So the one section in other comprehensive income will be items that may be reclassified to profit or loss, and items that may not be reclassified to profit or loss. So once again, if they test it, then you must split it like that. If they don't test it, there's no need to do that split. So other comprehensive income has two important aspects. Number one, that the line items like revaluation, mark-to-market reserve needs to either go under the heading of items that may be reclassified or under items that may not be reclassified. The second thing you need to be aware of is that each line item is either net of tax or gross of tax. So please be aware of that. Whether something is reclassified or not reclassified, the particular standard will tell you. So if I remember correctly, revaluation relating to PPE may not be reclassified. So therefore, it will be under the line item under may not be reclassified. Similarly, I think mark-to-market reserve for financial instruments may also not be reclassified. So it will be under the line item or under the heading called items that may not be reclassified. Like OCI, something goes to OCI if the standard tells you it must go to OCI. Likewise, something is classified under items that may be reclassified or may not be reclassified based on what the standard tells you. Okay, so just be aware of that. So that is the income statement. The cash flow statement, you will generally find all the details when we come to the cash flow statements. I'm not going to cover it here. There are high-level details in IAS 1, but the more details are in the standard IAS 7, I think, statement of cash flows. Okay, and then when it comes to the statement of change in equity, under the statement of change in equity, there's also specific rules in terms of how you need to show the statement of changes in equity. So generally, the statement of change in equity is split between transactions with owners and normal transactions, business transactions. So just please be aware of that. Okay. So I don't think there's more things. Oh, by the way, and then remember, so IAS 1 deals with presentation of financial statements. It doesn't necessarily deal with disclosure. It does give you some disclosure, like what needs to be disclosed. So generally, it will tell you any significant item, any material item needs to be disclosed. However, every particular standard, so for example, IAS 16 will have additional disclosures that is specific to IAS 16. Similarly, IAS 38, which is deals with intangible assets, will have a separate section that is of relating to disclosures, that is specific disclosures relating to IAS 38. Same for inventory, same. So every standard will have their specific disclosures. So when you look at disclosure, you must look at two aspects. IAS 1, general disclosures and general and presentation, and then the particular standard, which will give you the specific disclosures relating to PPE. So for example, in IAS 16, I-16 will tell you that you need to disclose the depreciation method. You need to disclose the useful lives. You need to disclose any change in estimate and so forth. IS-1 does not tell you that. IS-16 tells you that. IS-1 just gives you general disclosures and it gives you the specific presentations. Okay, so that's all that I wanted to cover for this lesson, and that is a general overview of conceptual framework, a general overview of IS-1 presentation of financial statements. My suggestion to you is when we do inventory um, is an asset. Okay, so an asset, the specific disclosures relating to inventory is found in IAS 2. But when we deal with presenting inventory, we can go, then you go look at IAS 1, look at an asset is on the balance sheet. So you read statement of financial position, see if there's anything specific relating to statement of financial position, and see how that links to inventory. But with inventory comes cost of sales. So that means you also go look at the statement of profit or loss and other comprehensive income and how that impacts inventory. And that is why I don't still do a specific question in this class, because we're going to link every scenario, every week's work back to the conceptual framework, back to IS1 presentation of financial statements. So just be cognizant of that. Oh, just one last thing when it comes to the income statement, and this relates to groups. The income statement or the statement of profit or loss and other comprehensive income from a group perspective, that is when you do a consolidated statement of profit or loss and other comprehensive income, the total profit and loss line item needs to be split between profit or loss attributable to parent and NCI. And then similarly, total comprehensive income attributable to parent NCI. Please take note, you are splitting profit or loss and you are splitting total comprehensive income. You are not splitting OCI. You are splitting total comprehensive income. So that's all from my side. Do you have any questions that you have? Please, you must make time to read your standards. You don't have to read the full standard. A good idea, not a good idea, a good approach would be as follows. For an accounting standard, um, look through the contents page. So I know the new standard don't anymore have an introduction. Yeah, I don't think the new standards have an introduction. So I still have the old. My one is, I think 2013 or 2016. I don't know which one I have. 2013 or 2016. And in there, you have like before the standard actually starts, there's an introduction. So when I open up IAS2, before the standard of IAS2 actually start, I have an introduction. So then you just read the introduction. The introduction gave you a high level overview of what inventory is all about or what PPE is all about. Now, I don't think the new books have an introduction. I think the ISB removed the introduction and they just have the standard. But what's a good idea? Just to browse through the standard to see what it's all about. Then when you attempt questions, then you try to read specific paragraphs. Because I know you are working, most of you are working, so you don't have the time to sit and read a standard, because it'll take forever. And you need to more sit with doing questions. But remember, you must think a bit further than just wanting to pass your exam. Think about that. That's why I asked you in week 0 to write why you want to become a CA, why you will pass CTA, and all of those type of stuff. You need to think big. You need to remind yourself that I'm not here to pass CTA. I'm here to qualify as a chartered accountant, and why I'm here to qualify as a chartered accountant. As a result of wanting to become a chartered accountant, I need to pass CTA. So very, very different perspective. Perspective one, which is not ideal, I'm here to pass CTA. That means you're just going to do whatever it takes to pass, as opposed to I am here to become a CA, and why? as a result of as a result of wanting to become a CA, I need to pass CTA. Very, very different perspective. Because that means I'm here to become a CA implies that you need to read your standards. If you are here just to pass CTA, there's no real reason to read your standards. You just need to do what it takes to get by. But if you're here to become a CA, that means you want to know your accounting standards. You want to be able to know how to read the I4Ss. You want to know what the I4Ss are actually saying. Um, you don't have to be like a guru. You don't have to be a guru. You don't have to be the technical expert, but you at least want to know what's happening within the book. Um, there's a very different perspective. So make sure you make some time to read. Now I know you are busy because most of you are working full time, and you don't have to study off after hours. So a suggestion to you is as follows: you probably have the new book. If you don't have the I4Ss, please make sure you have it. You get it. So remember, you only need to get the I4Ss. That is if it's still green or the red books, and then your income tax act. You don't have to worry about the other stuff. Oh, and then the auditing ones. Okay. So for the I4Ss, the new ones, and if you don't have the new ones, you have to get the new ones because there was too many new standards. Leases is new, revenue is new, I4S 9 is new. So you have to get the new one. Okay. I don't buy the new one, but I just look it up on the Cycle website. So when I prepare the notes or when I work through a question, I have the online one from the Cycle website. I read it from there. So the new ones would have two parts: the actual standard and then the application guidance. So all you need to try to get through is the standard. With the new approach at the way the ISB set out I4S is to have the standard, then it has Appendix A, Appendix B, and then other appendix. So Appendix A is generally the definitions. Appendix B is the application guidance. Now, what's very important, the standard is part of the standard. Appendix A, the definition, is part of the standard. Appendix B, the application guidance, is part of the standard. In the other books, you have illustrative examples. Illustrative examples is not part of the standard. Very, very important. The illustrative examples is not part of the standard. The basis of conclusion is not part of the standard. What is part of the standard is the actual standard, the Appendix A, the definition, Appendix B, application guidance. Now, what you must try to get through is at least the standard, even if you just browse through the standard. Like I said, the new approach has three parts. Well, it can have more than that, but the standard is very short, and all the detail is in Appendix B, the application guidance. So at least browse the standard just to get a high level view of what the standard is about. Then when you come across a question and if there's a bit complexity, then read the application guidance. Why the application guidance is very important is two reasons. Number one, how to actually apply the standard is found in the application guidance, and that is why the application guidance is generally much longer than the standard. And number two, examiners set questions based on the application guidance. So in some instances, the actual question with the actual solution is in the application guidance because the examiner simply took the example or the explanation from and pasted into your scenario, change the name, change the numbers. Because in the I4S X books, they don't say dollars and rands, they say CU, which is currency unit. That is their currency unit, because they don't want to use a particular country's um, like they only use rands and dollars. So all they do is they cut out that scenario, paste it, change the name to an actual company, and change the numbers to an actual dollar or rand value, and then there. And if you actually read your application, you'd pick it up and you'll just go to the application guidance and fetch the answer. So that's the two reasons. But the first reason is more important than how to apply the standard. Secondly, when it comes to revenue, very important to read that 69, I think there's 69 examples. Most of the, because revenue is new, most of the examples of revenue is taken directly from that, from those examples. So if you find the example and you look at the question, you basically just copy the answer that the standard gives you because the examiner just copied it. So just be aware, you want to read. That's why you want to read the standard and you want to read. And then, like I said, the application guidance, you probably won't get a chance to read everything in the exact week. But when you want to have some bedtime reading or Saturday and Sunday reading, then go through the application guidance. But you have to work through your standards. Okay. But that's all from me now. Do you have any questions? If not, we can end the lesson. So I'll start from the bottom. How do I pronounce your name? Walise. How do I pronounce your name?
You pronounce it Valise.
I can't hear.
Valise.
Valise.
Now.
Valise.
Valise. Yes.
Okay, so did I say it right? Valise.
Yes.
Okay, so do you have any questions?
No questions from my side.
Okay. Tandi? Okay. Happy with that. Ryan?
No questions.
Malatsi? Did I pronounce your name as well?
It's Mahlatsi.
Okay.
Mahlatsi.
Malatsi. Do you have
Yes.
any questions?
No, thank you. I'm good for now.
Narato?
No question for now.
Fakir?
No questions. Right?
Or didn't you?
No questions.
Okay. Eid? Fire, any questions? He's fine. Not something by his laptop. He's just on the clock.
Yeah, I think he said he just dropped off. So I don't know.
Okay. Yeah, she does saw your response. Okay, guys, and that's all from my side. I'll see you guys tomorrow for FAQ 4. Okay.